I'll be honest, I am terrible at day trading. And when I've tried to chase the fast money that I see online, I lose. But I have survived 12 plus years in these trading markets. And I've watched many traders come and go. Most traders think they are losing because they are bad at trading. That's not your problem. Your problem is a hidden cost that you pay every time that you look at social media. I call this the catch-up tax. Here's how it works. Every time you see a guru, every time you see a guru's $50,000 screenshot, your brain's amygdala, the part that handles fear and reward, triggers a hijack. You unconsciously increase your risk. Not because the market tells you to, but because a screenshot told you to. And that's the exploit. In this video, I'll show you exactly how this trap works. First, I'll reveal the math that proves why your social media trading feed is a lie. Then, I'll give you the clean room protocol to shut off the exploit instantly. And finally, I'll hand you the 30-trade firewall so that you never pay that tax again. So you scroll your social media feed, another guru posts a $12,000 win, and you look at your account, you are down $300 this week. You close your trading app and feel like an idiot. But what if your feed is mathematically rigged to show you a lie? If 90% of traders lose money, and broker data confirms this, where are all the losers on your feed? They exist. So why don't you see them? Think of the social media feed like a casino floor at 3 a.m. Every slot machine you see has someone pulling the lever. You walk around thinking, wow, this place is packed. Everyone is playing. But you don't see the 10,000 people who walked in at 8 p.m., lost everything by midnight, and went home. The casino floor looks full because only the survivors are visible. The 10,000 losers left, they are invisible. And your trading feed works exactly the same way. The traders you see posting wins are just the people still sitting at the slot machine. 90% of the people who walked in already blew up their accounts. They deleted their profiles. They went silent out of shame. You are not seeing a room full of winners. You are seeing the 10 gamblers who haven't left yet out of the 1,000 who walked in tonight. This is the graveyard scroll. You are comparing yourself to ghosts who have not posted their death certificate yet. So you open Twitter before your trading session, and your brain does this. Man, another guy just made $8,000 in a single trade. What's wrong with me? I've had this for 8 months, and I'm barely breaking even. Everyone else gets it. Maybe I'm just not cut out for this trading thing. Now, imagine you understood the math. The same feed, same $8,000 screenshot. But your internal monologue shifts. Interesting. He posted one winner. But did he show his last 30 trades? No. Did he show his account balance over time? No. So this is just noise. I'm going to check my own execution log instead. See the difference? Same input, but completely different reaction. You can't trust your eyes on social media. The sample is rigged. You need a mechanical filter to spot the ghosts. I call this the 30-trade firewall. Step 1. You see a guru claim a winning system or post a massive trade. Step 2. Ask one question. Have they posted a verified log of their last 30 plus consecutive trades? Step 3. If the answer is no, if they are only showing you screenshots or cherry-picked wins, veto. Dismiss it as a statistical noise. Now, why 30 trades specifically? Because statistically, anything less than 30 samples cannot distinguish between luck and a trading edge. A 5-trade winning streak has a 3.125% probability of occurring by pure chance, even with a coin flip. That's just 1 in 32 traders. With thousands of traders posting daily, dozens will post lucky streaks that look like skill. But a 30-trade sample, the probability of faking consistent profitability over 30 trades by luck alone drops to less than 0.001%. That's the mathematical threshold where you can separate signal from noise. A single screenshot is statistically meaningless. It could be luck, it could be Photoshop, it could be a demo account. But a 30 trade sample, that shows edge, that shows consistency, and that's maths that you can actually evaluate. So here's the trap. You'll see a guru post what looks like a real broker statement, and you will think, that's proof. It's not. Screenshots can be faked in 4 minutes with AI or editing tools. The only credible proof is a third-party verified link, something like my FX book, where the data connects directly to their broker. If they won't provide that, walk away. By applying this firewall, you stop comparing your real results to their fake highlight reel. You realize you are not falling behind. You are just the only one posting the truth. Screenshots in trading are marketing. Track records are math. Demand the math. But even if you know the feed is fake, seeing those numbers still triggers a dangerous biological reaction. You see a post, $50,000 in 1 month, and your brain does the calculation. I made $200 this month. I'm 250 times behind. Suddenly, risking 1% of your account feels too slow. You feel the urge to double your size, to take that mediocre setup. This is not ambition, it's a hijack. Back in April 2020, I became a rising star on eToro. New copiers were following my trades, comments were flooding in, and I felt like I was finally getting somewhere. So I started checking the platform constantly. I enabled email notifications for every new copier. I wanted to stay connected. But that was a big mistake. Sometimes I'd see someone praise my trades and I'd feel the euphoria. Other days I'd see a critical comment and I'd spiral. One morning, I saw another trader posting a massive return, much bigger than mine. Felt that chest tightening urge, that whisper, I need to trade bigger to match him. My risk tolerance wasn't based on my account size anymore. It was based on his. This is the catch-up mechanism. When you see a guru's $50,000 profit a month, your subconscious thinks, that's the standard, and I'm behind. Your risk tolerance does not increase because you analyze the market. It increases because you are trying to close a gap that does not exist. You've had a break-even week, solid execution, nothing special. Then you open Instagram and see $47,000 profit this month. My students are crushing it. And your internal monologue goes like this. I made $200. He made $47,000. At this rate, it will take me 20 years to get to where he is. Maybe I should just bump up my 1% risk to 3%. Just for the next few trades, I need to catch up. Now, I want you to picture a trader who understands this mechanism. Same post, same $47,000 screenshot, but the internal monologue is completely different. This guy is either lying, lucky, or risking 40% of his account to get these numbers. My 1% risk with a 2-to-1 reward to risk ratio, where I aim to make $2 for every $1 I risk, compounds roughly to 24% per year without blowing up. I'm more behind. I'm on a sustainable path. He's the one gambling. You can't willpower your way out of this biological hijack. The catch-up mechanism is hardwired. It's the same brain circuit that makes you feel behind when your peers buy houses or get promotions. You need a circuit breaker. I call this the 24-hour feed quarantine. Step 1, recognize the catch-up urge. The symptoms are physical: a racing heart, tightening chest, a sudden desire to increase your lot size. Step 2, the moment you feel it, immediately close all social media and trading apps. Don't negotiate. Close everything. Step 3, enforce a mandatory 24-hour trading ban on yourself after every trade, win or loss. No entries, no adjustments. Now, here's why this works biologically. The catch-up urge is a chemical spike, a mix of dopamine and cortisol that degrades your decision logic. Dopamine creates the craving to act now, while cortisol floods your system with stress, narrowing your focus to a short-term threat response. Together, they override your prefrontal cortex, the part of your brain responsible for rational risk assessment. This chemical cocktail does not dissipate in 10 minutes. It needs time to metabolize. Neurological studies on emotional regulation show that stress hormones take 18 to 24 hours to fully clear out of your system and restore you to baseline decision-making capacity. That's why the quarantine must be a full 24 hours, not 2 hours, not when I feel better. The biology does not care how you feel. The chemicals are still there. And this isn't just for catch-up moments. Professional traders enforce this after every trade to prevent both revenge trading, trying to win back losses immediately, and overconfidence. But here is where this fails. You'll convince yourself to just check once during the quarantine. Don't. If you peak, reset the clock. The moment you see another screenshot, the spike returns. But you might ask, won't I miss trades? Maybe. But if the setup is truly valid, your trading plan will catch it tomorrow. If it's not valid, you just avoided a revenge trade that would have cost you 2% of your account. Increasing risk to catch up does not close the gap. It just opens the trading grave. Look, the catch-up urge is a massive profit killer, but most traders have 2 to 3 hidden traps working against them simultaneously. What if social media comparison is just one of yours? I built the Why Am I Still Losing Money quiz to pinpoint your specific combination of profit killers in just 3 minutes. Click the link in the description to get your personalized diagnosis today. Now, you know how to stop the impulse, but you still feel bad about your boring results. Let's fix that comparison error at the source. Your last 20 trades, 9 wins, 11 losses, win rate 45%, net profit $200. It feels. Then you see a guru post, 5 wins in a row, 80% win rate this month, and your brain concludes, I'm bad at this. He's good at this. But what if you're probably making more money than he is? I want you to imagine you're a basketball player. You track your stats, 45% shooting, 12 points per game, solid and consistent. Then you watch LeBron James highlight reel, 10 dunks, 33 pointers, 0 misses. You think, LeBron never misses. I'm terrible compared to him. But LeBron's actual career shooting percentage is like 50%, only 5% better than yours. He misses half his shots. You just don't see the misses because highlight reels don't show them. You are comparing your scoreboard to his highlight reel. Trading feeds are the same. That guru who posted 5 wins, he did not post his 18 losses. His reel shows 100% win rate, but his actual scoreboard likely shows negative 12%. He's losing money while looking like a champion. Trading author Mark Douglas of the book Trading in the Zone discovered that successful traders don't think in terms of this trade will win. They think in terms of over 100 trades, my trading edge will show up. Mark Douglas used a casino analogy. The casino does not care if one gambler wins $50,000 tonight. They know that over 10,000 gamblers, their house edge guarantees profit. The casino is not gambling on individual outcomes. They are playing probabilities across thousands of repetitions. The short-term noise does not matter because the mathematical edge compounds over volume. When you see a guru posting one big win, you are seeing one outcome from their sample. You don't see the other 29 trades, which might be net negative. So you finish reviewing your week, 4 wins, 6 losses, net profit $180. You feel flat. Then you scroll Twitter. Another $12,000 a day. My system is on fire. And your internal monologue sounds like this. I made $180 in a week. He made $12,000 in a day. What am I even doing? I should just buy his course. Mine obviously is not working. Here is how a professional would think. Same stats, same Twitter post, but with a scoreboard lens. Okay, he's showing one day. What is monthly equity curve? Not posted. What is his average loss size? Not posted. My 40% win rate with a 2-to-1 reward to risk just compounded my account by 3.6% this month. His big day screenshot tells me nothing. I'm going to focus on my execution score instead. Here is the reframe that sets you free. I call it the reel to scoreboard translation. Step 1. You see a guru post a 5-win streak or a $50,000 profit. Step 2. Assume the industry standard win rate of 50%. That means for every 5 wins they showed, they probably have 5 losses that they didn't show. Step 3. Assume poor risk to reward, which is common for hype traders chasing high win rates. Their losses are likely 2 times bigger than their wins. Step 4. Do the calculation on their hidden scoreboard. 5 wins at $5,000 each, $25,000. 5 losses at $10,000 each, minus $50,000. Net, minus $25,000. They posted a $25,000 win whilst being $50,000 in the hole. Now, here's why this mathematical pattern is so common. High win rate streaks usually hide catastrophic risk management. These traders are risking like $500 to make $100. One bad trade wipes out 5 winners. This happens because achieving a 80% win rate requires taking profits early, that is, booking small wins, whilst letting losses run, hoping reversals will save bad trades. The psychology feels good because you get frequent dopamine hits from being right, but the mathematics are lethal. You are borrowing 45% win rate with a 2-to-1 reward to risk ratio. That's the mathematical signature of a sustainable trader. Let's look at the numbers. For example, 45% win rate, risk $100 to make $200. Over 20 trades, 9 wins times $200 equals $1,800. 11 losses times $100 equals $1,100 loss. Net result plus $700. The guru, 80% win rate, but is risking $200 to make $100. Over 20 trades, 16 wins times $100, $1,600. 4 losses times $200 minus $800. Net $800. It looks close, right? But here is the trap. One unexpected loss where the guru does not set his stop loss, risking $200 but losing $600, wipes out his entire month. His system is fragile, but yours is built to last. But you might be thinking, but won't I grow too slowly with a 45% win rate? Let's do the calculation. A 45% win rate with a 2-to-1 reward to risk, risking 1% per trade, compounds to roughly 20 to 25% per year. That's better than most hedge funds, and you never blow up. But the guru's 80% win rate, 1 10 losing streak, and he's down 40% because his reward to risk is inverted. A 45% win rate with a 2-to-1 reward to risk makes you rich. And an 80% win rate with a 0.5 to 1 reward to risk makes you broke. Choose boring. Boredom is the badge of the professional trader. Wear it. So we've covered the mathematics, the biology, and the logic. Now let's solve the root cause permanently. We've talked about the filters and the reframes, which are useful tools. But here is the harsh truth. As long as these apps are on your phone, you are fighting a losing battle against billion-dollar algorithms that are designed to hijack you. Willpower in trading is a battery that drains. Your environment is a wall that stands. I don't usually check social media before trading, not because I am disciplined, but because I knew I am weak. I knew that one glance at a Lambo post can derail my 1% risk rule. I know that seeing another trader's screenshot, even knowing it might be fake, still can trigger my catch-up mechanism. In April 2020, after that period where notifications were affecting my emotions, I took action. I disabled all my eToro email notifications. No more alerts for new copiers, no more pings for comments. Then I made a strict rule: log into the platform only once per day. And that was in the morning only. The result wasn't just peace of mind. My execution improved immediately. I didn't learn a new strategy. I didn't find a better indicator. I just removed the FOMO trigger. The feed was hijacking my risk tolerance without me even realizing it. By cutting the noise, I stopped playing the catch-up tax, and my risk tolerance returned to 1%. So here's the nuclear solution. It's extreme, but it works. I call it the clean room protocol. Step 1. Block all trading-related social media apps from your phone using app timer. Twitter, Instagram, TikTok, Reddit. Stick to using your laptop or desktop for trading. Step 2. Install a website blocker on your computer. Block trading forums and social platforms during your trading hours. Step 3. Replace the habit. When the urge to check the feed arises, open your trading journal instead. Review your last 10 trades. This redirects the dopamine-seeking behavior towards something productive. Now, here's why this environmental intervention works when willpower fails. Willpower is a finite cognitive resource. Research by psychologist 𝑀𝒊𝒎𝒄𝒓𝒊𝒑𝒕𝒊𝒐𝒏 showed that self-control deletes with use. Every decision you make drains the same mental battery. By the afternoon, after dozens of micro decisions, your willpower reserves are exhausted. But environmental design does not require willpower. If the app is blocked on your phone, you can't check it, even in a moment of weakness. You've removed the decision entirely. This is why casinos don't have clocks or windows. They engineer the environment to eliminate the decision to leave. And you're using the same principle, but in reverse. Engineering your environment to eliminate the decision to stay. You are not fighting willpower. You are not fighting willpower against a billion-dollar algorithm. You are removing the trigger entirely. When you trade in a clean room, your only inputs are your trading plan and the charts. The trading ghosts can't reach you there. But here's where this fails. You leave one backdoor open: a Discord notification, a YouTube subscription. Block it all. The algorithm will find any crack and exploit it. But you might be thinking, but won't I miss important market news? Price action on the chart tells you everything the news will tell you without the emotional manipulation. If something happens, you will see it in the trading candles, the red and green bars on your screen. You don't need a guru to interpret it for you. But what about educational content? Schedule it. For example, 1 hour in the evening. Batch your consumption. Never mix education with your active trading window. When you are trading, you are in execution mode, not discovery mode. The social media feed is a tax on your trading, and blocking it is the refund. When you trade in a clean room, it's just you, the chart, and your plan. You stop wondering if you are falling behind because there's nothing to fall behind from. You realize that boring was the goal all along. Boring execution, boring consistency, boring wealth building. The gurus are playing a different game. They are optimizing for followers, but you are optimizing for profits. Let them have the screenshots. You take the returns. I mentioned earlier that willpower is a battery that drains, which is why even good traders crack. But what if you could replace willpower with a system that makes discipline irrelevant? Check out this video where I show you the TLS Veto filter that forces you to trade like a casino so that you never have to rely on self-control again. See you in that video.